Welcome to another deep dive. Our mission today, well, it's about cutting through all that noise, the information overload. We want to help you pull out those really invaluable nuggets of insight from whatever sources you're looking at, show you how to truly understand what matters. Today, we're working with two sources, very different on the surface, but actually surprisingly complementary. The first one, it's like a blueprint for great conversations. It outlines some kinds of questions that really get to the heart of things. And the second, a real-world example, dense corporate stuff, a shareholder letter that definitely requires a keen eye to unpack.
Exactly. And our goal here is to show how that structured approach to asking questions, like you find in a really well-done interview, well, it isn't just for talking to people. It's a powerful tool you can apply to pretty much any source material, helps you grasp not just the what, but the why, and I think most importantly, the so what.
Right. We're hoping for some aha moments today, showing you how to turn that raw info into real understanding. Okay, so let's kick things off with this first source then. This detailed list of podcast interview questions designed to spark engaging chats. Why is this list relevant? Especially when we're about to tackle, a dense financial letter. How does that connect?
Well, what's really fascinating here is that these questions, they're not just for interviews. They give you a powerful framework for pulling insights out of anything. Think of them like a mental checklist. They let you shine a light on different parts of a topic, moving way beyond just the surface facts, kind of like X-ray glasses for information.
X-ray glasses, I like that. Okay, let's quickly run through a few of these main categories, see what kind of deeper insights they unlock. Like general personal or intro questions, they seem basic, building rapport. But what's the deeper power there?
Yeah, they do more than just build connection. Questions like, what inspired your journey, or what habit changed your life? They actually help you understand foundational drivers, core values, maybe even someone's personal operating system. And if you apply that thinking to a company document, you start looking for the underlying philosophy, the motivation behind the strategy. It's about finding the why behind the what.
Makes sense. Okay, then we have career and business questions. Things like biggest breakthrough moment or how do you handle failure? These seem pretty direct, but how do they help us decode, say, an organization's report?
Well, these questions, they dig into strategy, resilience, growth. So if you're dissecting a business document, you're hunting for evidence of those exact things. How did they start out? What mistakes taught them the most? What's their game plan for the future? Munger, in this letter we're looking at, he's implicitly answering a lot of these.
Okay. And investing in finance questions. What's your investing philosophy or best tip for beginners? How do those help with a company's financial story?
They're like direct lines into understanding financial thinking, the financial acumen. When you read a report, you're not just staring at numbers. You're trying to figure out the philosophy behind them. Are they about growth, stability, preserving capital? How do they look at opportunities, manage risk? These questions help you read between the lines of the balance sheet.
Right, read between the lines. And crucial today, technology and innovation questions. What emerging tech excites you? How will AI change things? What kind of foresight are these getting at?
They're probing adaptability, future-proofing, really. For a company you're looking at, how do they stay current? How do they handle rapid change? What innovations are they actually chasing? I mean, in a world moving this fast, understanding a company's tech mindset is probably just as vital as understanding its current books.
Good point. Finally, the fun and lighthearted questions. Fun fact people don't know. These seem, well, lighter. Is there a deeper insight to be had?
Absolutely. They connect with the human side, even in a really dry corporate document. Sometimes you find these little anecdotes or, insights into leadership's personality. They give you a more rounded picture, sometimes reveal what someone values outside work, and that can provide some pretty unexpected context. So if you step back and look at the big picture, you can see how methodically using these types of questions, even just as a mental checklist, it lets you build a really comprehensive picture. It doesn't matter if you're interviewing a person or, like we're about to do, taking apart a dense corporate document. It's about being a strategic reader.
A strategic reader. I like that. Okay, so now we've got this mental toolbox full of questions. Here's where it gets really interesting. Let's actually put this idea to work. Structured inquiry on a dense, real-world document. We're looking at excerpts from the 2009 Wesco Financial Corporation letter to shareholders, penned by the legendary Charles T. Munger, Chairman and President. This is a perfect example of something that can feel, overwhelming. But With the right approach, we can pull out the critical stuff.
Yeah, and this letter gives just a fascinating look, almost unvarnished, really, into a company's performance during a super challenging time. The tail end of the Great Recession.
Yeah.
It's got granular financials, but also these broad strategic insights straight from one of the sharpest minds out there.
Okay, let's hit the big picture first, right away. What's the immediate story the numbers tell us? Wesco in 2009 versus 2008.
Well, the immediate story is it's a pretty clear decline. Overall profitability took a hit. Consolidated net operating income for 2009, it dropped significantly, down to just over $54 million. That's $7.59 per share.
Okay.
And that's down from nearly $78 million, or $10.89 per share in 2008. Consolidated net income saw a similar drop too, and it's important to note the 2008 number actually included some after-tax investment gains, about $4.5 million. Those are completely absent in 2009, so that makes the 2009 operating decline look even more pronounced.
Got it. So a definite hit to the bottom line. Now, Wesco isn't just one thing, right? It has these 4 major subsidiaries. To really get what's going on, we need to break them down, see how each one did, what challenges they faced. Let's apply that sort of career and business questions lens here. See their struggles, their pivots.
Absolutely. That granular view is crucial. It shows you where the company's strengths and weaknesses were in '09. Let's start with Wesco Financial Insurance Company, WesFIC. That's their reinsurance arm, out of Omaha. Interestingly, they actually managed to flip things around. They went from an underwriting loss in 2008 to an underwriting gain of about $7.2 million in 2009.
Oh, okay.
Their investment income did decrease, though.
And there was this key development, right? This big retrocession agreement they made at the start of 2008 with National Indemnity Company, NIC, which is Berkshire Hathaway. That sounds like pretty complex insurance talk. What does retrocession agreement actually mean for WesFFI?
Yeah, that's a great question. And it's a really critical piece here, a retrocession agreement. Think of it like reinsurance for a reinsurer. So Nico, a huge insurer, had taken on 20% of Swiss Re's property casualty business. Wesfex then took on 10% of Nico's piece.
Right.
So Wesfex is taking a slice of Nico's risk, which originally came from Swiss Re. It's called quota share reinsurance. They share the premiums and the losses proportionally. For a smaller player like Wesfex, it was a strategic move. It let them get into these huge, high-quality reinsurance deals and scale up their premium volume really fast, and it definitely boosted their activity. Premiums written went from $265 million in '08 to over $294 million in '09. Earned premiums jumped even more, from $183 million to nearly $277 million. They also kept participating in aviation pools run by Gen Re, another Berkshire company. But what's really fascinating here is Munger's honesty. His candid admission about the, quote, inherent imperfections of financial reporting in this business, especially reinsurance.
Why?
Because you have to estimate future costs and losses. He flat out calls them mere best honest guesses. That tells you a lot about his view on accounting transparency.
Yeah, that's very Munger. And then there's float. Munger and Buffett famously love float. How did this deal affect WesFIC's float?
Ah, yes, the float. That's the money Wesco holds from premiums before they have to pay claims. It's basically interest-free capital Munger can invest.
Right, free money to work with.
Exactly. And thanks to that Swiss Re deal, WesFIC's float ballooned. It went from $76 million at the end of '07 all the way up to $264 million by the end of '09. For an investment-focused company like Wesco, growing float is a massive strategic advantage. It's like getting free capital to put to work.
Makes sense.
And their combined ratios, they were 94.9% for 2009, 101% for 2008, and 93.9% for 2007. The letter points out these were much better than average for insurers.
And just to clarify, the combined ratio
Lowers
better.
HBR.
Below 100% means profit from insurance itself.
Precisely. It adds up underwriting expenses and losses as a percent of premiums. So anything under 100 means you're making money just from writing insurance before you even count investment income. So WesFIC's 94.9% in '09 shows really strong underwriting discipline, especially in a tough year. That's a definite plus.
Okay, so WesFAC showed resilience, even improved its core operations, boosted by that strategic NICO deal. But not all of Wesco's businesses had such a good story, did they?
Yeah.
Let's shift to the Kansas Bankers Surety Company. This sounds like an older asset, and it faced a pretty sharp turn.
Yeah. Owned by WesFI, Kansas Bankers insures community banks in the Midwest. Based in Topeka, chartered way back in 1909, Wesco bought it in '96, called it a very satisfactory acquisition. They offered things like crime insurance, even internet banking theft coverage.
But then September 2008 happened. right in the thick of the banking crisis. What decision did they make?
Exactly. Kansas bankers made a really tough call. They decided to completely stop writing deposit guarantee bonds. Why? Because of everything going on in banking, including failures. They actually took a $4.7 million after-tax loss from just one bank failure late in '08.
Wow.
So applying our career and business questions lens, this is where you'd ask Munger about handling setbacks, making pivots. The letter tells us they saw a fundamental change in the risk, they reacted decisively, but it meant a huge drop in their insurance volume. Those bonds were almost half their written premiums in 2008.
Half. That's massive.
Huge. Their licensed states dropped quite a bit, and they planned to pull out of more. Their reinsurance strategy changed too. In '09, they only reinsured about 1% of their volume, way down from almost half before. And Berkshire Hathaway companies had become their only reinsurers back in 2006. So their combined ratios here were pretty wild. 140.2% in 2009.
Oof, well over 100.
Yeah. 111.6% in 2008, but only 55.1% in 2007. Very volatile. But despite shrinking the business, Munger expressed sort of a long-term optimism. Expecting volatile but favorable long-term results suggests confidence in the remaining, more stable lines.
Okay, volatile, but maybe ultimately favorable. Let's turn to Court Business Services Corporation. This sounds totally different. Furniture rental. How did they do during the recession?
Yeah, Court, based in Virginia. They're the big player in rent-to-rent furniture in the U.S. Wesco bought them in 2000 for about $386 million cash. And the Great Recession, well, it hit Court hard. They went from making a moderate profit to an actual after-tax loss of $1.4 million in 2009.
A loss.
Yeah, compared to a $15.7 million profit in 2008. Their core revenues dropped almost 20% in just 1 year. Shows you how widespread the economic pain was.
They also did some acquisitions around then, right? Tuck-in deals like Aaron Rent's division and a UK group. Did those help cushion the blow?
Not right away, it seems. Court was trying to expand its relocation services for businesses and government, but those efforts hadn't really taken off before the recession slammed the brakes on everything. So the focus shifted pretty quickly to just cutting costs, damage control. But the letter notes Court still had a strong competitive position, big network, and for 2010 they projected disappointing profits, but importantly, not another operating loss. So maybe seeing the light at the end of the tunnel, but a tough road.
Okay. A tough road for Court. Finally, let's look at Precision Steel Warehouse, Inc., another industry that gets hammered in downturns. What's the story there?
Yeah, Precision Steel near Chicago, steel warehousing, especially metal products. Munger says it was pounded by the Great Recession, and not just the recession, but also this long-term trend of manufacturing moving overseas, reducing demand, revenues just plummeted. Almost $61 million in 2008, down to $38.4 million in 2009. Sales volume dropped by a third.
A third, wow.
It operated at an after-tax loss of $7.6 million in 2009, compared to an $8.8 million profit the year before. And Munger specifically points out the impact of LIFO inventory accounting. He notes that without LIFO, the loss would have actually been bigger, $2.1 million after tax in 2009.
Okay, LIFO, what is that exactly, and why does Munger highlight it?
LIFO stands for last in, first out. It's an accounting method where you assume the last goods you bought are the first ones you sell. During a recession, especially if commodity prices like steel are falling, LIFO can actually make your profits look artificially higher because you're matching recent sales revenue against older, possibly cheaper inventory costs.
I see.
So Munger points it out to give shareholders a more realistic picture of the actual operating loss. It shows his commitment to, absolute transparency even when the news isn't good. And he's blunt. He explicitly calls Precision Steel not a satisfactory investment outcome, especially compared to what he used to earn, averaging $2.3 million from '98 to 2000. A key worry he flags. The general and ongoing decline in Precision Steel's physical volume is a serious reverse, not likely to disappear. That's a tough assessment.
Doesn't sound good long term.
No, but interestingly, he praises the CEO, Terry Piper, says he did an outstanding job leading through tough times, focusing on cutting costs. So even in a struggling business, Munger recognizes good leadership.
Okay, so that covers the four main subsidiaries. Beyond their individual performance, what else does the letter tell us about Wesco's overall financial health, its outlook? Any other pieces to this puzzle?
Yeah, there are a few other bits. Munger mentions what he calls tag ends from Wesco's old savings and loan business. Mainly a small real estate company, MS Property Company. It holds some appreciated real estate, like Wesco's headquarters in Pasadena, and, interestingly, a newly built luxury condo building, but he says its results are immaterial. Though Under other operating earnings, there was a loss of nearly $7 million in 2009, and that included a big $6.2 million after-tax write-down on that very condo building.
Ouch.
Yeah, build right into the worst condominium market in decades. A stark reminder that even smart investors can get caught by bad timing and macro factors they can't control. The company does highlight its unusual balance sheet strength, mostly from the securities held by the insurance subsidiaries. Cash-rich, strong balance sheet. However, Munger is remarkably blunt again about the net worth per share figures. They crept up a bit, from $337 in 2006 to $358 in 2009, but he describes them as not impressive.
Not impressive.
Okay.
Oh. And this leads to Munger's really direct, almost, I don't know, it's a startling warning.
This, I think, is maybe the single most significant insight in the whole letter. Munger states, completely unequivocally, that Wesco is not an equally good but smaller version of Berkshire Hathaway.
Wow.
He goes on, each dollar of book value at Wesco continues plainly to provide much less intrinsic value than a similar dollar of book value at Berkshire Hathaway. And he adds that this quality gap has, in recent years, continued to widen in favor of Berkshire Hathaway.
That's incredible.
It's a remarkably candid, significant statement coming straight from the chairman, basically telling shareholders, look, your investment here isn't as good as owning Berkshire. You just don't see that level of directness often.
No, you really don't. A chairman openly saying, my company isn't as good as that other related company. Astonishing transparency. Okay, finally, just a quick note on dividends.
Right. The board had recently increased the regular dividend, but only slightly, from 39.5 cents per share up to 41 cents per share, payable in March 2010. And the letter actually credits Director Elizabeth Peters for suggesting the increase, specifically to make sure shareholders got paid in even pennies, which is, a small detail, but kind of telling about their focus on shareholder detail.
Even pennies. Okay, so wrapping this up, what does this all mean for you, our listener? We've taken this deep dive into two really different sources, a guide to asking powerful questions and this complex corporate financial report. We've seen how thinking about question categories can guide how we explore any topic, even a dense letter.
Yeah, and we've really demonstrated, I hope, that even the most packed financial documents can yield incredibly valuable insights if you approach them systematically. Understanding the specific challenges, the strategic moves of each subsidiary within Wesco, it paints such a richer picture than just looking at the top-line numbers, right? It lets us see Munger's candid thoughts, the resilience in some parts, the real struggles in others, all against that tough recession backdrop.
This whole exercise really highlights that being well-informed, it isn't just about memorizing facts or figures. It's more about understanding the story, the narrative, the challenges, the pivots, those underlying dynamics. It's about asking the right questions, even of a piece of paper, to get to the real core of it.
And that brings up, I think, an important question for you listening right now. Given Charlie Munger's incredibly blunt assessment of Wesco's value compared to Berkshire, what does that tell you about how important it is to critically evaluate everything, even official company communications? And maybe more subtly, how do you tell the difference between a company that's just struggling because of tough times and one that might have more fundamental, inherent quality differences in its actual business model?
Yeah, good question. What stands out to you from today's deep dive? How might you take this framework, this idea of asking insightful questions? How might you apply that to your next information challenge, whether it's a news article, maybe a research paper, or, hey, another annual report? That's it for this deep dive. Thanks so much for joining us, and we look forward to the next one.